Hello, everybody. If you followed my channel before, you've probably heard a very similar intro on every video, and I'm trying something new. I'll start a little bit differently, but still get into the stuff that we normally talk about. So, most retirement strategies are broken, and the herd keeps following the same playbook, which doesn't mean they're going to get different results. So, let's talk about how we flip that script to where we use a better playbook, maybe just a different playbook, so we can get those results we're looking for. My name is Daniel Young. I'm the founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I'm going to talk about closed end funds and how we use those inside our portfolio to completely game the system. I mean, yeah, completely game the system. So, uh, disclaimers, this is an unedited video that's filmed in my house. So you might hear some background noise. And just to be clear, I am not a financial advisor, though I am a strategist and a financial strategist. So, where to start? Quite honestly, this would be our week to invest, but I am not prepared to invest tomorrow because I have been doing a ton of writing lately. Uh, Still working on Substack, but in preparing for that launch, I realized that it was probably beneficial that I backpace a little bit. As I was writing the Substack content, I realized that I was going to showcase or debut or post a book, an ebook, uh, detailing out our 12 steps to financial freedom, and realized it would probably be beneficial to have that book already written when I start Substack. And then in writing that book or in editing and polishing and finishing that book, I actually wrote two others. So I'm working on three different books at the same time. Uh, the 12 steps is in the process of getting polished. And in the midst of writing that, I wrote a scholarship strategy, or at least I wrote down the scholarship strategy that I've told everybody. And then I finally wrote down the entire closed end fund strategy to where it's a part of the 12 steps book, but it's also its own book. So I'm working on that. And in working on that, I did not do my normal stuff, which is kind of frustrating on my end of things. And that, I mean, there's only so much time of the day. My efforts this weekend have, I don't know, I just feel like there's still not enough time. I'm trying to streamline my thought, streamline my actions and my time, and just didn't get to it. So I didn't do the normal closed end fund deep dive. I updated the funds, and I will attempt the full system update this week. Um, I'm still writing three books or polishing one and writing and editing and polishing the other two. Um, and it's just kind of an ongoing list of life as is. So please bear with me and please give me some grace. It was an early morning for any number of reasons, but it was an early morning and it's just been nonstop since. So I wanted to make this video, but at the same time, I also wanted to make a different video than normal. I mean, my goal has been to make the recent portfolio update video as well as the uh, a video of a how-to of how I update our portfolio with new funds, but neither of those happened this weekend. They were scheduled, just didn't work out. So I'm going to attempt a different video on here because the market's really just the same. I mean, despite a couple things this week, nothing's really changed. And I don't feel the need to remake the same video from the past 3 weeks and say the same things. So I'm going to update some things as is, give you some, I'll give you an opinion like normal, talk about closed end funds for the week, and leave you with some strategy. So, what happened this week? Honestly, not much. The jobs report is still wobbling from past policy meddling. Gold is super hot right now. It's like 3,500 an ounce, which is crazy. And the Fed may or may not step in. But that's where we've been. Um, the bigger issue is the herd's panic. They are prepared for a panic, and it's kind of what we saw at the beginning of the week when the bond market had a sell like a random sell off. And maybe it's not so random if you get into the deeper underlying issues in the bond market, but still, the bond market had a slight panic, and then that fizzled out by Friday, right? And the brief spells of that nature of this nature just they just don't make sense if you think about it. But that's exactly what the herd isn't doing. They don't think that they're following their handler's bells and just doing things kind of willy-nilly, like without a care in the world, which is really crazy if you think about it, because that's your retirement money or your fund money or whatever other money you're throwing in the market. Hopefully, it's not fund money, right? But the long and short of the bond market is this: that bonds are back with the Treasury buying up long end supply and the short end issuing, tamping down the dollar. Bonds and municipal bonds are a great deal right now. And with that cheaper dollar, stocks are still looking pretty good too. But that's kind of status quo. I mean, I don't want to say it's not a big deal, but that's been the status quo for at least the last month. Last week, last week market experts were pushing bonds, and then they weren't pushing bonds, and now they're monkey panicked and went on a rampage. And now the same analysts who missed last week moves are writing guides on investing in uncertain markets. I'm serious. I've read those articles. It's just, it's the blind teaching the blind. I mean, I just don't get it. It's, and I've seen maybe three, which is crazy. I've seen three articles with that title, Investing in Uncertain Markets. Same exact topic, which tells me that the teleprompter screen is giving them the marching order, right? Because, I mean, I don't know if you've noticed this. I hope you've noticed this. Those experts have been wrong a lot. And as for investing in uncertain markets, I mean, isn't that kind of all the time? I don't want to be a fence rider and I don't want to be a cynic or a naysayer, but there's risk when you invest in the market. And we can confidently go about our investments if we read the signs of the market. But at the same time, the market is always uncertain, right? Because I can have my strategy and I can have my thoughts on the market and I can have my uh, portfolio and mind wrapped around where I think the market's going to go. But the herd is that panicky school of fish. They are flighty and they make the market uncertain. And if you trace it back, you've got the herd or that school of fish and their handlers, and then whoever is putting the writing on the teleprompter screens. Those people make the market uncertain. So I find it obscenely unhelpful that the same people last week who were like, bonds are a great idea, that bonds are not a great idea. Now bonds are a great idea. And then how we invest in uncertain times. It sounds like they need their own self-help guide on how they should invest in uncertain times, not necessarily lead somebody else on how to invest in uncertain times. It's just like it'd be helpful if they wrote an article on addressing your doubt and investing with confidence, because that's really what it boils down to, regardless of what the market's up to. And with the herd, it's anything, right? Which is what those teleprompter jockeys want, which is what the people who write the words for those teleprompter idiots to read. So no one wants to lose money in the market. and it's all risky. The biggest thing is increasing your knowledge, increasing your wisdom by increasing your knowledge, and investing with confidence. And if you can't justify what you're doing, then it's probably not worth buying. Not that the worth is inherently wrapped up in the stock, but on your end of things, if you are not confident in what you are doing, then you cannot confidently go forth with it. And I don't want to be like, I don't want to double speak and I don't want to talk condescendingly and act like I'm beating around a bush, I guess you could say. But so when I invest in stuff, there's this inbuilt hesitancy. Like, do I really want to do this? Because I'm spending money. It's not like I'm buying a coat at pick a store. I'm buying a stock, and I don't know if the value of that stock's going to go up or down. Now, I can project it to go up, and I can project it to pay me a fat dividend, like a pat on the back, thank you for buying my stock. But that might not, like the price itself might not increase for a while. So how we buy and when we sell, like all of that's wrapped up in our strategy. But at the same time, when I buy stuff, it's like, do I really want to do this? And that's partly why I make these videos, because it forces me to explain things. And if I cannot explain why I'm doing something, then it's probably not a good investment. And if I'm like, I really should do this, but there's part of me that holds me back. Like I can't explain it, but it just feels wrong, then there's a bigger issue that I'm missing. Because if it feels off, it's my brain trying to tell me, like, hey, that's not a good idea. But if I can elevate my knowledge and if I can improve and increase my wisdom, and if I can rationally and logically look at the stocks we're buying and justify why we're buying them, and the strategy meshes, like it's a long term focus, it's buy the deals in the current market with a long term perspective. So read the current market, scoop discounts, build a dividend machine, and then have it pay out for the long term versus the quick buy and sell or the quick flip. I'm not for that. It's growth over time, push the dividends forward, hold it for the long haul. And if you need to sell it, sell it. Like I'm not saying like buy and hold all your stocks. That's not the strategy. But it's a long-term vision. It is build a dividend machine, something that will pay you day in, day out, month in, month out, regardless of what the market does and regardless of what the herd does. Buy the discounts, use their fear, regardless of what's happening in the market at any given time. There is a deal to be found because the herd pushes into sectors. They don't like bifurcate or even diversify. They just like it really is like herding sheep or herding a school of fish. Like they just make a beeline for the food trough in greed, and they get there late, and they leave. They get there late, and they leave too late. So if we can identify where they are, there is a deal to be had. Scoop the deals in the current market with long-term vision. And if you can do that and learn, the built-in hesitancy is good. It's like, I mean, I don't skydive, but there's that little bit of hesitation. You watch skydivers, there's that initial little bit of hesitation when they're about to jump out of a plane or off a cliff, right? And then they jump. Like your self-preservation goes, hey, is this a good thing? And your mind says, yes, it's a good thing for these reasons. And then you do it. And if you can do that, you put yourself in a different category, different echelon of investors than the common herd investor. So it's not that we're following the same guys that are wishy-washy. right? That I think this, I think that, flip flop, flip flop. Investing in uncertain times, right? The best thing we could do is not listen to them, right? But do your research, do your work, study, dig into the data, right? And then invest with confidence. I'm way off track. I have a script and I'm way off track. And I doubt I can somehow circle that back and pull it back together. So I'll just reorienting back to what changed in the market. Uh, let's see, US GDP expanded by a little more than 3% for the last quarter, and consumer spending and business investment are heating up. Those are good things. There's increasing probability in the odds market that the Fed cuts rates this month. And to that, I say, we'll see. And then lastly, I mean, AI is still booming, but the biggest winners in the AI race are going to be those small to mid companies, the guys who profit off of innovation. And then you've got huge innovation coupled with lower cost because quite honestly, technology is cheaper than people. I mean, that's not we're replacing you with a robot, but the algorithm itself is saying we can do this a lot more efficiently without you. So innovation plus lower cost plus boosted sales equals growth and rapid growth. And that increase in competition is good for everyone. It's good for the companies, but it's also good for the consumer. So, market wise, not much has changed. So, where does that leave us? And quite honestly, it's the same place. Bonds are great. Bond po- bonds and bonds proxies are great. I'm tired. Bonds and bonds proxies are great. They're still underpriced a little bit, depending on bond company, and it's still a good deal. Oil, yes, but not supplier. I mean, oil is still like $60 a barrel, which is cheap. That's not a lot of profit to be had. But if you go more in the energy transfer guy or like a toll bridge, what gets the oil from supplier to consumer, that's a good market to be in. So maybe maybe more focused on mover than driller. And then yes, it's tech, but it's not big name tech. It's anybody who will profit with tech, and that is everybody. And then stocks. I mean, so you get strong GDP, dollars, the dollar is weaker, but it's also there's tariff money and this uh, rolling in of money into US manufacturing and US consumer base and US jobs markets. So US stocks are a good idea as well. So all that to say is that even with the current market, right, we're kind of neutral on the fear and greed index, but at the same time, things have gone up. And we want that. Like we want our overall value to go up. So with the market running higher than what it's been, there are still dividends and discounts and deals if you know where to look. And that's the best place about the closed-end fund market space, because there's always, or I will say there's almost always a discount. I won't say always, but there is always a discount on something. Something's always downtrodden. Like if stocks are hopping, then bonds and real estate are not. Like the market moves in waves, and if you follow the herd, you're going to miss the deal. So here's what the breakdown looks like, but I'm not going to go through the giant sorting that I normally do. Let's see. Share my screen. So I took the normal list and I shortened it down to this. And this OXLC data is is inaccurate. Um, I don't know what happened with CF Connect, but they had the discount off. They had the NAV off, and the dividend share price they had at 45 cents a share, which it hasn't been that way in a while. So it's it's definitely not this, but it's more in line and consistent with where it's been. It's still a great fund to buy. Let's see, HFRO for real estate, HGOB is up. I well here of the list, HGOB, which I've talked about at length before. Huge investment in the midwave wireless. Otherwise, more portfolio when it can, but it's kind of hit and miss. It's like it's like scattershot. You're going to get bigger pockets of hitting the paper in some areas, and this like almost missed in others. NBXG is all 5G tech. ADX is blue chips. Last I checked, it was less than 100 companies. So I really like the focused and centralized investment. USA is a blue chip powerhouse as well. BRW I've talked about almost every video. Biggest thing is the discount has narrowed, which is great. Like we want that, but it's not as good of a deal at 6% off. DLY is the sister fund to DSL, and it's a fund that's been known to pay hidden dividends. So with a good bond market environment and hopefully with a Fed cut, whether the price changes or the dividend changes, they have the added hype or maybe added potential of paying a hidden dividend. And then RLTY, it's just 100% real estate. It's just a little bit different than HFRO, which is commercial storage building, which is I guess is still commercial to a degree, and then single family homes and rented homes. So of the list, what would I pick? And I'll be forthcoming. I'm not prepared to invest tomorrow. My thoughts have been elsewhere and not on buying. It's been about writing and strategy and just other stuff. So, but if you ask me to trim down the list, and I've thought about this since the last video where I really had a hard time figuring out the list. So here's what I would do. BRW is great, but the discount is not as wide as it's been. DLY, same thing. 2% off is great. The last year it's been about a half, but it's been wider. And then RLTY, same idea. Currently at 2% off, but it's been wider. So if we're trying to target deals and sticking with stuff that's just so all of these are significant for their individual funds, but if we're still trying to separate the sheep from the goats, as of which are better than the rest, like they're all significantly different in discounts. They're all triple asterisks and targets. But if we're trying to further winnow that down into these are the best deals of the bunch, that's kind of what I'm going on. USA is a decent buy. ADX is a decent buy right now. NBXG sits higher than where we bought it on average. Their discounts a little bit less. HGLB cost more. HFRO is higher than our average. The yield has slipped because, I mean, their dividend's the same. But if you were going to really force me to buy something tomorrow, I would do this, which is very, very different for me. I don't know how else, it's very outside my normal because only one of these is a monthly payer and its dividend is going to go down in October. It will go down a penny. But it'll still pay like a 21% dividend. Oh, sorry, 26% dividend based on current data. Um, but with these two not paying for like 2 months into the future or even 3 months into the future, that's normally not like me. Like I want to buy something that will pay me a dividend this month, if not next month. So to buy something that won't pay me a dividend until December or January is not like me. But if it really comes down to discount, and we're trying to prioritize discount and buy the stuff that has a greater discount now than where it's been trending the last 6 months to a year. These are the best deals. So it's kind of strange. It really is. It's strange for me that I would pick two quarterly payers and not go straight monthly. But such is life. I mean, such is the market right now. So I think I'm going to leave it there. Uh, to be honest, to be just 100% transparent and honest, I am exhausted. Uh, and is gosh, as much as I love closed-end funds, it has not been my focus the last week as I've been trying to get my thoughts in order, writing strategy and writing systems and writing these books. So if we were investing tomorrow and we're not, I would pick one of those three funds or those three funds. I would pick that batch. Um, but we're not investing tomorrow. One, because I haven't prepped well to buy tomorrow. Two, I'm tired as it is. And three, my brain is still focused on writing strategy, and I need more space in my head to get back into closed-end fund, long-term, like long-term strategy mindset to buy funds instead of just buying funds based on whatever I think is, yeah, that's not, no, that's not me. So I need to resolve one task and then come back to the closed-end fund portfolio before I buy the next round. In doing so, my goal is to make the portfolio update video. And then my goal is to make a video on how to update the portfolio. And I plan to post the how-to video on Substack, even though I don't have Substack open right now. But that how-to video would go inside the Substack files. So please cut me some slack. Please give me some grace. Um, it's been a long week and it's been a long day. So if you found value in the video, hit the like button, drop me a comment, and then help me hack the algorithm for YouTube, or let's hack that algorithm together. And then if you want to connect day to day, you can always leave me a comment here. I mean, you can go to Substack, but I'll be honest, there's a page there and nothing else because I've got work to do. Um, but yeah, drop me a comment here. Tell me what you're investing in. Tell me what you think about the video. Constructive criticism, please. Um, if you think it was shit, just tell me why you think it was shit. Um, tell me what you're investing in. Tell me what you think about the final picks. Tell me any number of things. So, the last advice I'll leave you with is this: do not follow the herd. Focus on you and focus on building your own dividend machine. So, this is Daniel Young signing out. I will see y'all on another video at some point. So, have a great week, everybody. Bye bye.